How's it going? I'm Barnett. I'm a financial advisor at Wiser Wealth Management. Just going to take some time today to discuss some changes to the 72T interest rates that were announced with the IRS. I've mentioned in previous blogs and other videos about what 72T or substantially equal periodic payments are. What those are for clients who have qualified assets like retirement accounts like IRAs and 401ks pre 59 and a half. So in order to bypass the 10% penalty on early withdrawals, you could do what's called a 72T distribution. And that would be where you take certain payments. There's three different options. You could do an RMD payment, you could do a fixed amortization or a fixed annuitization payment. So there's three different ways you had to calculate these and stick to them. And you had to do those for 5 years or up until age 59 and a half, whichever one was later. They just announced some changes called Notice 22-6. And what that is it changed the interest rates on these calculations. So previously, the calculation was based on a factor of life expectancy, and then it had a calculation on 120% of mid-term federal rates. However, unfortunately, with the low interest rate environment we're in, a lot of times these percentages weren't enough to supplement the income needs of retirees. So they changed the rule where you can still do that amount, but you can also now do anywhere from 0 up to 5% as your interest rate calculation. So this can significantly increase the amount that you need. Obviously, you don't have to use the full 5% calculation if you have other assets to supplement retirement, but this was a very helpful addition, allowing clients to have additional income from these retirement accounts. Example would be for a 53-year-old under the previous calculations of the 120% and 33.4% life expectancy rate, you would have only been able to withdraw about $32,151. Using the 5% interest rate now moving forward, the amount's almost doubled up to $62,189. So as you can see, that's a pretty significant increase for those clients that actually need access to these full retirement accounts in order to live up until they have other income needs from other accounts after 59 and a half or from Social Security. So this is a nice added benefit, as well as they also updated the life expectancy tables. So as clients and individuals are living longer, they've changed what the calculation factor is for life expectancy. So not only will RMD calculations be slightly changed moving forward, but this has also changed somewhat of the calculation in these 72T interest rate payments. If you have any questions on how this applies to you or some options for yourself and future retirement, feel free to subscribe to our blogs and our podcasts, and also feel free to reach out to us. Thank you.